A stock just jumped 30% in a single day. Not Nvidia, not Palantir, not one of the names dominating financial headlines every week. It was Hewlett Packard Enterprise, a company most investors stopped thinking about years ago, and that single fact tells you something critical about this market right now. So let us ask the obvious question first. What is Hewlett Packard Enterprise, and why does this matter to you? HPE is a technology infrastructure company. They build the servers, storage systems, and networking equipment that power the modern digital economy. If artificial intelligence is the engine, HPE builds part of the factory floor underneath it. For years, they sat quietly in the background. Not glamorous enough to trend on social media, not exciting enough for most retail investors, just a steady, unglamorous business doing infrastructure work. And then this week happened. On June 1st, HPE reported earnings that analysts described as the biggest beat since 2018. Revenue came in higher than expected. Earnings per share crushed the forecast. The stock responded immediately, 30% in a single session. To put that in perspective, a 30% gain in one day is extraordinary by any standard. That is the kind of move most investors wait years to see in a single holding. And it happened in a company most people had already mentally retired. Now here is the question worth sitting with. How does a company like HPE suddenly post a result this strong? The answer connects directly to the AI story dominating 2026. Alphabet just announced plans to raise $80 billion through stock sales to fund AI infrastructure. Anthropic was valued at nearly $1 trillion in pre-IPO funding. Every major corporation on Earth is racing to build AI capacity. And all of that AI capacity needs physical infrastructure, servers, data centers, networking hardware, storage systems. That is HPE's world. When companies spend aggressively on AI, the money does not only flow to the software firms with the flashiest names, it flows down the supply chain, into the companies building the physical layers beneath the technology. HPE sits directly in that flow, and this earnings report confirmed it. But here is where this gets genuinely interesting. Most investors chasing AI gains in 2026 are concentrated in the same handful of names: Nvidia for chips, Microsoft for cloud, Palantir for data analytics. That concentration is understandable. Those companies have had extraordinary runs. But when the entire investment community crowds into the same trades, two things happen. Valuations get stretched, and the companies nobody is watching quietly accumulate the real gains. HPE's 30% move is a real-world example of what that looks like. Investors who dismissed it as a boring legacy tech company missed a single-day gain that took years to earn elsewhere. If you are finding this useful, consider subscribing for more practical financial insights. So what is the lesson here, practically speaking? Let me walk through the thinking. Every major technology cycle in history has produced obvious winners and hidden winners. During the internet boom of the late 1990s, everyone chased the dot-com startups. But the real steady wealth often built in companies like Cisco, which supplied the internet's physical backbone. The AI cycle of the 2020s is following a similar pattern. The spotlight is on the AI model builders, the software companies deploying the models, the chip manufacturers powering the compute, but the infrastructure layer beneath all of it is enormous, and it is populated with companies that trade at much lower valuations than the headline AI names. HPE this week proved that the infrastructure layer is not sleeping. It is actively benefiting from the same capital wave, just without the crowd watching. Now let us think about what this means for different kinds of investors. If you are early in your investing journey and just starting to build a portfolio, the HPE story carries an important lesson. Do not only chase the names everyone else is already talking about. The best financial decisions are often boring decisions. Infrastructure, fundamentals, earnings consistency. These are not exciting dinner party topics, but they are how wealth compounds. If you are a more experienced investor managing a larger portfolio, the question worth asking is this: how much of your AI exposure actually sits in the infrastructure layer? Or are you entirely concentrated in the software and chip names that every analyst is already covering? Diversification inside a theme is just as important as diversification across themes. The software sector broke out above its 200-day moving average this week. Oracle, ServiceNow, and Microsoft all surged on strong earnings. The AI rally is spreading across multiple layers of the tech economy simultaneously, and HPE's move suggests the infrastructure layer is joining that expansion. There is a broader truth sitting inside this week's news. The S&P 500 just posted its 9th consecutive weekly gain. Markets hit record highs driven by AI optimism, falling oil prices, and a fragile ceasefire between the US and Iran. In an environment like this, it is tempting to feel like everything is going up and any stock will work. But that is exactly when selective thinking matters most. The companies posting genuine earnings beats are doing something real. HPE did not jump 30% because of sentiment. It jumped because the numbers actually came in. In a market full of optimism and elevated valuations, actual earnings results are still the anchor. Companies that deliver get rewarded. Companies that disappoint get punished. That dynamic never changes regardless of how bullish the overall market feels. There is one more thing worth noting here. The AI investment cycle is now large enough to show up as a meaningful driver of economic growth. Edward Jones noted this week that the AI investment frenzy is increasingly reflected in its rising footprint in economic growth data. This is not speculation anymore. The capital is flowing, the infrastructure build-out is accelerating, and it is showing up in company revenue, in earnings reports, and now in single-day stock moves. The question for every investor is simple. Are you positioned to participate in that build-out, or are you watching from the sidelines while the infrastructure layer quietly delivers? HPE's 30% day will be a footnote in the broader AI story, but it carries a clear signal. The biggest gains in any market cycle rarely come from where everyone is already looking. They come from understanding the full picture, following the capital, asking where it actually lands, and being willing to look at companies that feel less exciting on the surface. That is not a complicated strategy. It is just one most people skip. What you do with that is entirely up to you.